Hey there, Tex here with you for part 2 of our Wyckoff logic series, now looking at distribution. In video 1, which I highly encourage you to have a look at if you haven't watched this one yet, we spoke about the accumulation phase before this markup, the accumulation being the cause, the markup being the effect, all of which was created by Richard Wyckoff back in the 1930s. Very relevant still almost 100 years today later in 2020. So we'll be looking at distribution being the cause and the effect. Obviously, in this accumulation phase, this is where the composite men or the whales want to be buying BTC or the asset at the cheapest price in from the retail traders who are capitulating and FOMO selling after this extensive downtrend. The opposite is the case with distribution. We reach a buying climax before this distribution, and the mark down being the effect after the cause. So the accumulation zone, we shared this with our private guys on January 13th. We understood and we realized, and all the signs were there, that we were in an accumulation phase after this extensive downtrend here from around 13K. We double bottomed around 6.5, which was our leading distribution zone here. And then lead 2 days on, 8727 was our target. 2 days on, we hit just over 89 or around 89. That's where we closed our positions at 8728 now before this descending move downwards from here. And now we're sitting at around 8613 current time. So let's look at distribution. Again, it's just the opposite of accumulation. This occurs at the top of an uptrend rather than the bottom of a downtrend. So let's get straight into it, and then we'll go over the 5 rules for trading Wyckoff. So in phase A, this occurs when an established uptrend starts to slow down due to increasing demand. This preliminary supply, remember in accumulation, we were looking here for a potential holdup of the market from continuing downwards. While we're doing the same thing here with BTC. At this point, we're looking to test the market and see if we can start pushing the market down or stop it from going up. And it's a failed selling attempt at this point. So from there, we reach what's called a buying climax. Just like the retailers FOMO selling or panic selling at the bottom of the downtrend, we've got the retail buyers FOMO buying the very point of the top of the market. That's what we want to avoid as traders. So we hit the buying climax and then we come down with quite an aggressive selling pressure here, which creates our automatic reaction. This is the excessive demand that's being absorbed by the market maker. So in other words, the composite men or the whales start distributing their holdings into the late buyers, and this secondary test then occurs when the market revisits this buying climax region, just as it did with the selling climax region, our automatic rally, and our secondary test within phase A. So this all really occurs essentially within phase A, as it did with our accumulation zone. So phase B, this is again our cause before our effect. This is the leading distribution zone, or this is when the most distribution is occurring from whales back to the retail traders before the eventual mark down effect. So usually the upper and lower bands of this range are tested a few times. In this case, we didn't get it playing out exactly as what I guess you would look for so much, but certainly all the signs were there once again. And as we know, the markets don't repeat, but they often do rhyme. So if we can see most of the ingredients there for a distribution schematic, we will often take some note of that, along obviously looking at our other indicators and volume of the market and the general sentiment at the time. And we did share this with our members around this point here, which is around the 17th of July in 2019 in one of our private sessions. So in phase B, we get what's called our upthrust. As I said, usually the upper and lower bands of this are tested a couple of times, which may include short-term bear and bull traps. Sometimes the market will move above this resistance, which is created by the buying climax. In this case, it didn't happen, which will result in another secondary test that can also be called an up thrust. So we didn't have an up thrust above the buying climax at this point, but we certainly had an up thrust here from our SOW, which stands for a sign of weakness. So coming into phase C now here, in some cases, the market will present one last bull trap that we certainly did have here after this consolidation period. It's called a UTAD. and that stands for upthrust after distribution. It's basically the opposite of the accumulation spring. So we saw here we had one last point of supply, last point of support rather, before our upthrust and our sign of strength. Conversely here, we have our upthrust after distribution before our last point of support here, or last point of supply. So coming into phase D, it's pretty much a mirror image of our accumulation one, going up, going down. And it usually has a last point of supply in the middle of the range, creating a new lower high. So from this point, new lower points of supply are created either around or below the support zone. And an evident sign of weakness appears as well when the market breaks below the support line, which we had here. So even if we had our support line down here, it still was a secondary sign of weakness and sort of one last little bit of capitulation before we had a minor recovery here. So in phase E, the last stage of distribution marks the beginning of the downtrend, an evident break below the trading range caused by strong dominance of supply over demand. Now, it didn't exactly play out like that. As we played this, we did expect a move up before an eventual run down. Keeping in mind here, we've come from 13.8 and then moved down to 9.15. We would also obviously see other things as well, like our trend lines to depict whether we were in a bear market. Were we making new higher highs? No, we weren't. We were making lower highs. So that was a confirmation in itself that we were in a bit of a downtrend. Now, this is a 4-hour chart moving along. We probably would have done something like this, or something like that perhaps, to confirm. Now, we also did mention too as well that we need to see the opposite in terms of volume. We need to see quite an increase in selling volume, a decrease in buying volume, which we did. And we know that these things don't play out exactly right. We could have a markdown, which is our major downtrend, which then continues into another level or another trading range on a micro scale before another markdown or another level of distribution where the whales are selling again into the market. They could have picked up here around 9, or they could have picked up here around 9.1, run the rally up, and then they distribute once again into, and we can see here, this is almost like a little mini point of supply. We would have had a buying climax, an automatic reaction, a secondary test, a little bit of an upthrust, some signs of weakness here, a major sign of weakness here as it breaks below the trend. So you can sort of see how these play out on minor scales, not just major macro scales. And this could take a long time to play out. So as it kind of did with this. So as we continue and zoom out, we certainly sort of ranged for a little bit here before this major selling event where we came down and tested 7.3. Again, another major selling event and this ultimate downtrend where we tested 6.5 a couple of times. And then this leads us back to our first video on the accumulation phase where we are now. So this is all explained in Unity Trading Group /Wyckoff. And of course, before we finish off the video series, we need to explain the 5-step approach to trading the market. So what is that? And this is the final part of our Wyckoff series. So step 1, you need to determine the trend. And you can do that by looking at larger time frames. Are we in a major downtrend? Are we in an uptrend? We're in a downtrend until we at least make a higher high at this point, confirming that we are out of this macro downtrend. So what is the current trend and where's it likely to go? How is the relation between buyers and sellers? Are there more buyers in the market or more sellers in the market, which are going to be continuing to push price down? Number 2, you need to determine the asset's strength. How strong is the asset in relation to the market? Is the asset moving in a similar or opposite faction? Do we have an increased volume with decreased price? Do we have decreased price with increased volume, or vice versa? 3, look for assets with sufficient cause. Are there enough reasons to enter a position? Now, this is major. You don't just look at one metric to determine whether we're going to enter the market. Are our indicators lining up? Is sentiment lining up? Is volume lining up? Is the trend showing strength? Don't simply just enter based on one metric, and certainly don't enter what you hear on Twitter. So what is the position? Is the core strong enough that makes the potential rewards worth the risk? Step 4, how likely is the move? Is the asset ready to move? What position is the bigger trend? And what do the price and volume suggest? This step often involves the use of Wyckoff's buying and selling tests, which we'll talk about in later videos potentially. Step 5, you got to time your entry. The last step is all about timing. It usually involves analyzing a stock or BTC, in this case, in comparison to the general market. So, example, a trader can compare the price action of a stock in relation to the S&P 500 if we were looking at the reg markets, depending on their position with their individual Wyckoff schematic. Such an analysis may provide insights into the next movement of the asset. So eventually this facilitates the establishment of a good entry. So there we go. In closing thoughts, Wyckoff is a really powerful tool if you can identify it. No doubt it works out. The proof is in the pudding of what we said to our members. We identified it. We got a great run. We got a test of what we believe was going to be the major resistance line for this immediate point. Certainly was the case, and we were really happy with the result. But it's not something that occurs all the time. You really do have to look for it and look for correlations and look for confluence amongst indicators, times. Depending on what indicators you use, you might be looking at MACD. You might be looking at things like divergence here on the CCI, giving you indications of things that might be correlating with one another. You might be looking at MACD crosses in the histogram here. We got divergence between the MACD and the MACD line and our signal line. There's a whole bunch of things to look for, but certainly when they all line up and you see the ingredients for an accurate accumulation or distribution phase, then it's certainly worth paying attention to. So where are we going from here? Well, I'm not going to speculate. We can only look at what the Wyckoff logic tells us. Will we continue up in this Elliott wave fashion? Will we have more impulse moves up towards a buying climax and our next potential supply zone before we then start the mark down? Is this going to be our range for 2020? Let's wait and find out. Look forward to sharing it with you. You can see more at unitytradinggroup.com. Of course, come over to our Discord, Facebooks, and Twitters for more information or to ask questions. And we look forward to seeing how this year pans out and trading it with you. Thank you so much for watching. All the best.